Hello guys, my name is Emmanuel Sagai and I'm a currency trader and investor. I've been trading the financial market for 4 years now, and on this video I'm going to walk you through a system which works on all asset class, be it you are trading crypto, forex, stocks, bond, anyone, just name it. This video is for you, and I believe that by the end of this video your views, perspective and approach as to how you view the financial market as a whole will change. Please hit the like, subscribe and share this video to the fans by the way. Thank you. And let me walk you through my screen. Welcome to my YouTube channel once again, guys. Like I said in this video, I'm going to walk you through a system which works on all asset class. Alright, and to start with, I believe you're familiar with the basic market structure, right? Which is we see price making lower highs, lower lows, lower highs, lower lows, right? Which is termed the downtrending market. When price is making series of highs and lows, right? Which is termed the uptrending market, alright? And we've been told to always like trade with the trends, right? So it's very, very key to know where the market is trending to as to directional bias, alright? Now I'm going to walk you through the origin of price as to how this whole thing originated, because sometimes we get to find ourselves, right, in situations like this. Market creates a high, a low, a high. It could break this low, it could go back up to come here, make a high like this. It could make its way back up. All right, we've been caught up in these kind of situations a lot of times. All right, so in this video I'm going to walk you through an origin of price, how to actually interpret price action as to what it is, how to actually interpret price action like a pro. All right, I'm talking about the origin as per now you're not just looking at it from a higher high, higher low, higher high, higher low, higher high, higher low perspective, in the sense that as a trader that we buying the bottoms, right, at good prices. They're looking to take the price up, but the reality is that's not how price moves. All right, it's important to actually understand how price actually accumulates, distributes, how orders are being compounded. All right, so that's why it's important to look into price. Right, so I'm going to walk you through price interpretation and understanding price action as to what it is based on real data. All right, so yeah.
Okay, so let's say we have point A. Are you with me? We have point A to point B. So price now moved from point A to point B. Now this is telling you now that there is demand at point A. Alright, and if B holds price, it's telling you that there is supply at point B. Does that make sense? So now the demand moves price from point A to point B. Alright, now consider this scenario again. Let's say we're in the auction house, alright, where they are selling something. Now let's say they want to sell this car. Okay, they want to sell this car. This is a car. I don't want to draw. So this is a car. They want to sell this car, and this car is worth $2. I'm going to give you the origin of price action now. This car is worth $2, and now we have market participants here who are willing to buy this car. All right, and also we have market participants here who are willing to buy this car. It's an auction house. All right, we have market participants here who are willing to buy this car also. Okay, so now based on this car has its floor price, the original value of this car is $2. Are you getting me? So let's call this car, let's say participant A are sitting here and participant B are sitting here. So now this is the car in the auction house. Okay, so now this auction official has already list this car for sale. Okay, he has said, okay, now you guys can start bidding for this car. Then participant A will shout, I'm going to pay $4, $4. Are you getting me? Automatically, participant A is owning this car right now when he has said he wants to pay $4. So this car price has now moved from $2 to $4. All right. Let's now put it here, $4. Are you getting me? Then now it's time for participant B, because it's a auction house. These guys can even still as well call again. You understand? Until the thing is that they will have this battle until one person now finally takes the car home. All right. So participant B now will now shout, let's say these guys will now say $5. All right, because they want to see how far these guys have strength to push price. All right. Now during that moment, before these guys will bring out their buying power, price will start pulling back. All right, price will start pulling back because they want to buy this thing at a discount price, not premium. Are you getting me? So because everybody now they are thinking now, like they will not start talking with each other. How much you have? How much you have? Let's shock these guys. Those kind of things. The participant B will now shout $5. Are you getting me? So as they now bring this thing to $5, the value is now what? $5. So automatically they are driving this asset price moving from $2 right now to $4. Right now it's in $5. Participant A can come now because that it is not going to be an immediate action. Remember, it's the auction house, they are playing money because these guys don't want their money to finish so that these guys will now go home with the car. And these guys too, they are doing the same. They don't want their money to finish so that these guys will now go home with the car. But automatically right now, they've already lifted this original car price. They've lifted this price of this car to right now it's currently worth $5. Are you getting me? And the cheapest price that anybody is now willing to pay for this car is like, let's say from this range now, from $2 to $4. All right, the cheapest range that people are willing to pay for this car right now, when it was from $2 to $4. What is the half price of $2? Like if you should look at from 2 to 4, now obviously the cheapest price would have the discount price would have been around let's say $2, like half of this basically. All right, so now they will want to wait for price to pull back again. Since these guys brought this price, hope you're understanding me. Since these guys brought this price to $5, now when price is now pulling back, in the sense that these guys are now thinking like they're not thinking. So these guys should not be happy. They'll be thinking that these guys have already lost the battle. That means they are not the owner of the car. They're not thinking. The next thing, one big man will just come for me and shout, I'm going to auction this car for $8. Is it making sense? That someone for participant A now for this shop these guys now and say I'm paying for this car for $8. All right. So now these guys now be like, these guys are taking us on our way. Somebody will not come because in the sense because they are playing with big money. You understand? So they don't want a situation whereby they will go and call out a figure that they will not be able to afford after that. You understand? So you don't have to be careful. So let's say when price is not pulling back again, in the sense of, think about it like this: when price is pulling back, the auction house, they are negotiating during negotiation. All right. So these guys now, based on now the value is now rating at $8, these guys can now come and shout, I'm going to put it at $10. Or these guys now shout, these guys they are shocking us. This is the origin of price. Are you getting me? This is the origin of price. So let's say as at $10 now, these guys, their money are finished, so they don't have any much money to move price high, anything higher. So obviously participant B will now go home with the car, in the sense that the lowest price that people were now willing to pay for this car is sub around $8, and the highest price point to pay for this car is $10. Are you getting me? Now, this is now where the structure now comes, is that anything above this high, nobody is willing to buy above this high. But anything below here, people are willing to buy because it was the last price that participant A were willing to pay. Are you getting it now?
Yes.
So this was the last price that participant A were willing to pay, and this was the highest price that participant B used to shock them. Okay, so anything around here, people are now going to be happy to buy this asset. So this is the cheapest price right now. So the floor price is no more $2, it's now what, $8, and the highest price right now is now what, $10. Okay, so if they want to sell this car right now, the car has now found value, in the sense that, okay, participant A now, they now agree that fine, participant B have already beat us. You understand? So if you want to buy this car next time, with the car now, let's say, because some people now they will now go and be doing fake of the car. So let's say the fake of the car will now be sold at, let's say to be sold at that kind of $8, $9, then the original gongo will be sold at $10. Alright, let's say if you see original want to go buy somewhere, you see it as $9 or something. Do you understand? So people are not happy to pay for this asset. So when they are happy to pay, the market tends towards be balanced. Are you understanding me?
Yes.
When they are happy to transact, the market tends to be balanced. All right, now this balance now, this is now bringing the form of when we are talking about auctions. All right, but I'm just talking on market structure today. Only market structure. I don't want to complicate anything. I want to follow that rule, this table. All right, so this now brings to the point where we're not talking about what. Balanced. Now, in market structure, they will tell you that the structure of the market, we have three types of market, which is the uptrend, higher high, higher low, higher high, higher low. All right, traditional higher high, higher low, the lower high, lower low. All right, and they will tell you we have a ranging market, which is a lie. Are you getting me? Which is what? A lie. Now, the reality is that we have two types of market. All right, which is what? The imbalanced market, IMB, and balanced market, BAL. All right. Now, what is the imbalanced market? This is a market whereby people are seeking value. Are you getting me? Where people are seeking value, when price is moving point A to point B, back to point A, back to point B, break point B, create a C. So see, price is seeking value. Higher high, higher low, higher high, higher low. They are seeking value. So your traditional uptrending market and downtrending market is imbalanced. Just the same way I explained it here. During the process for price appreciating from $2 to $4 to $4 to $5 to $5 to $8 to $8 to $10, this is telling you now that people are looking for comfort. When they finally find that comfort, when they finally find where they can transact at, when the price, like asset, is now active in the market for sales, people are not happy to buy, people are not happy to sell. Alright, in the sense that people are buying low, people are selling high at $8 and $10. This is now where balance has been formed. But anything from here, are you getting me? Anything from here like this is imbalanced market. So the market. Do you have any questions?
I understand. No.
Okay. So this is when market is seeking value, in the sense that we are moving from one point to another point, from one point to another point, from one point to another point, from one point to another point. All right. So now, when market has done these things and found value, let's say market now finds value here. Okay. This now leaves. Remember, each point here are structural points. Each point here are structural points. Each point here, like each turning point in price, these are structural points. Okay, but why I now started disagreeing with the concept of higher high and higher low? Because most times you tend to see price create a high to create a low, to create a high to create a low, to create a high to break the low, to make a lower high. It will come here, it will test this point, this previous low, it used to break the up. It is ever dynamic. You can never tell how the market wants to move. But if you understand it from the point that every point is a structural view, if you had a trade here to take you out, then you know, man, that is moving from it's moving from the next one. Why? Because people who bought here, they'll be able to now have this asset. Look at the price scale, 1.297 or to 1.296. That's the whole 100 points. All right. So they were able to get more of the others here. Are you getting me? If they were buying here before cheap, all right, so they'll get it here cheaper. That is the benefit of a structural point. Are you understanding me? In the sense that,
Yes.
okay, in the sense that people who transacted here, all right, before are still active. So they will not want price to just break through just like that. All right, price will create a high, price creates a low. All these are structural points. If this structural point does not hold, this other one will hold. What is more important is your higher prices. That price is moving from $2 to $4 to $8. Is it making sense now? All this under lower low that price is creating, all these lows, it is not relevant. But rather, you have to see them as one structural points that you could expect price to come and turn here. Because the truth is that price cannot just create a high just like that randomly. Like price can't just move from point A to point B now. Point now pull back, it's not creating a high randomly. There is something that push price to create that high. And if price now move from here again, there is something that make price to create that high. So if price is accepting and closing its order higher than this, let's say this price, so this previous price is higher than this previous price, this previous price is higher than this previous price. Are you getting me? That's telling you that this asset is being valued to the upside. So when the market structure breaks to the downside, are you now going to change your bias and start selling randomly just from here? No. Are you getting me? You are going to look for value because whoever is driving this price, they are seeing that this asset is right now is valued at $8. Then now, based on the seeing the value is at $8, the market is now pulling back down. They did not catch the price here. Don't think that they will not be like, this is the best price to get this thing now because if we not buy here, we'll not get to say it at $8. So I have much more to make to the upside. Is it making sense now?
Yes.
So that is the concept of market structure. Okay, that is the concept of what? Market structure. Now, imbalance and balanced market. Balanced market is simply where value has been found. All right, where people are happy to transact. All right, where people are happy to transact. This is a typical example of a balanced market. All right, and this is a typical example of an imbalanced market where price is creating highs and lows because we don't know where the original value is, in the sense that yes, of course, price is moving from one point to another, one point to another, one point to another, all right, one point to another. But if value has now been found and they feel that okay, this is the highest price point to achieve this price, then now you will notice that they will not start transacting from point A to point B, from point A to point B, from point A to point B, from point A to point B. Are you getting me? In the sense that people are not happy to transact, and what this essentially telling you is that anything here is what we call premium. Anything here is what we call discount. Are you getting me? So price moves from when, let's say when value has been found, for example here, all right, price will not do something like this, do something like this, do something like this, do something like this, do something like this. In the sense that value has now been found, then whoever now has much money, when the asset is either it appreciates from here or it devalues. Let's say if it devalues, fine. Let's say it appreciates, fine. But that is the concept of market structure. But now that we have seen the market now has value here, all right, what are you now going to be expecting? Now, in the sense that this point were previous price point of value, all right, you cannot expect that. Let's say when price now spikes away from here, you cannot expect price to turn over from this structural point because you believe that the value is moving from 2, 4, 6, 8 and it's now valued at $8. You cannot believe that okay, I can get it very cheap to buy it at $4 and I cannot sell it here at $8. So this is like extreme discount. This level is discount level, but this is like extreme. These are when we are looking at auction, I'll touch all these things, but this is extreme. Does that make sense? So it's not the random higher low that we know that you are talking that we're looking at anymore. Do you get? So you are looking at it from a marketplace perspective. Alright? From a what? Marketplace perspective. Now, market structure shifts. Alright? What is shift in market structure? Alright? Market structure shift now. When my price makes a high, a low, a high, a low, a high, a low, a high, break of structure. Okay, when it breaks this first structure, all right, now price pulls back and confirms the next one That is when we can now tell that it has successfully shifted. Are you understanding me? When price is coming down, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Break of structure, price retest here. We are not sure yet. As at this point, this is the thing that most people do. They start trying to catch this first move. The truth is that this first move is actually a move which was supposed to continue going what? Down. Are you getting me? But if you notice now that this first move is not sufficient to now break this high, so you can now call this one your low, your high. So you can now name this one as your higher high. Are you getting me? Because when this first structural point breaks, it is not like, because obviously right now this asset is being devalued to the downside. Alright. So when this market shifts to the upside, people who actually sold from here before, price needs liquidity to move. Remember, I'm not teaching you smart money because I don't even know how to trade smart money, but price needs liquidity to move, however, from here. So from my own perspective, I feel that because this is a structural point, whoever believes that this thing should sell from here, because they will not just give up just like that. It's not possible, because they've sustained the price downwards the first time, second time. So what makes you think this fourth one to just blow and start going to the upside? Don't try and predict, always react. So now after this first break, price could now come here. Remember, it is a structural point for a reason. Are you getting me? All these are structural points. So price cannot react from this next structural point and use to sell lower. It can even break this thing and go to the downside. Are you getting me? But it can never happen like this, that price will now break the downside like this and now shoot to the upside like this. Yeah, there are scenarios like this, but it's very rare. Alright. But price cannot come back down here too and test this previous structural point. If it wants to now change the structure, it's not confirm a double bottom for you. This double bottom now is not telling you now that, okay, fine, I now see what they're trying to do. People are happy to pay, Then you now notice that this thing actually is now like, look, price is now ranging. Are you getting me? Before market structure should shift, that you should trust. Alright, price needs to suffer. What do I mean by suffer? Price needs to accumulate orders. Are you understanding me? So price needs to accumulate orders. It could be that price is downtrending like this now. If you're downtrending, then the momentum is slowing down. The price comes, you notice that price is testing previous structural points for the first time. Then you are now see something happening like this. Now, what is this telling you? What is this telling you? When a structure fails to the upside, what does that tell you? Okay, what does that tell you when a structure fails to the upside? Right?
That they are willing to pay to buy and sell.
Exactly.
Like,
Man, and find where there's value. Are you seeing my screen?
yes.
Let me go again. When price creates a high, a low, a high, a low, a high, a low, a high, and a low, then now price is failing to create a new high. Now this is telling you that, let's say you are seeing rejections here. This is telling you now that there's lack of demand to push this price higher. Are you getting me? So based on there is lack of demand to push prices higher, price will now come back and look for where there was demand before. Now, where was there demand before? This structural point here. Are you getting me? Here, there were demand at this point. Are you getting me? But what price usually does is that it usually comes to test for its orders at this recent low, alright, that tries to break that high. It will now come down and do something like this. Are you getting me? This point now is telling you now that sellers are active here and they are willing to pay for this asset here. And this area now, they are active here and willing to pay for this asset here. Now, based on they were seeking to test demand, they are looking for demand because this demand here was not sufficient enough to break this high before. Are you getting me? They will now come and test previous price, all right, where when they was structure. You understand, which is this low that you are seeing here, all right, which was this previous low. They will now come and test here. Are you getting me? So when they now test here, if they now see if they see sufficient demand, yes, price can break. But if the demand is not sufficient here, they will not come to the lowest price here. It must move back up. That's why when you see all those break of structure now happens, they try to form smartest guy to take you out. Are you getting me? Because whoever was active in the marketplace now that was willing to pay, remember, there's lack of demand to push this price higher. But now that price is not there's now the price not coming down to seek demand. Price can come here, it can even come here. But once it now picks that demand at a cheaper price, because people are willing to pay for this asset here at a cheap price before, now they will still pay for here. Alright, but now this is not like there's too much orders here, for example. And don't look at it from a liquidity perspective. Oh. The things are there's demand here, people bought here, people bought here. Now the value of this asset has been valued automatically, it has value to the upside because we had people who were transacting at these higher prices from 2,468. Alright, so net at $8. So now what now makes you think that price is just $8? Then the owner, somebody that suffer and took that. Remember the car example I used. You imagine in the auction, as you suffer and take your car to all the way to $8. They now finally have the car, they just devalue it. It's not possible. Are you understanding me now? It's not possible. The value still remains on that car. The thing is that auction people, when these guys have already sold the car, the way price is coming down, price is going to be testing where these structural points. Are you understanding me? It's going to be testing out this structural point because it's going to pick demand from one of the structural points and take price back up. That is when you now see that we are having auction, because once you see that there's lack of demand to push prices higher, it's saying that there's no much buyers active to push the market up at this point. Alright, so we cannot drag your consolidation from this high to the previous low and leave the thing like this. You see, the market it will start ranging and it will just start ranging. Are you understanding me? Now your own objective now is not to now try to catch that thing from here and here. And the truth is that price must move from here and here with what now? With help of support and resistance. That's